Ladies and gentlemen, good day and welcome to Alicon Castalloy Limited's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani from CDR India. Thank you, and over to you, Mr. Vaswani.
Sure. Thank you, Yusuf. Good afternoon, everyone, and thank you for joining us on Alicon Castalloy Limited's Q1 FY26 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, and Mr. Shyam Agarwal, Chief Marketing Officer of Alicon Castalloy Limited. Mr. Vimal Gupta will provide an overview of the operating and financial performance for the quarter, and following which Mr. Agarwal will walk us through the developments in global markets and insights on domestic business. Thereafter, we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared earlier. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good afternoon, everyone, and welcome to Alicon Castalloy's Q1 FY26 earnings conference call. I will start with some exciting developments that reflect our commitment to growth. There have been two recent additions to our senior leadership team. Mr. Manish Kapoor has joined us as our new Chief Operating Officer, COO. His extensive industry experience of over 30 years and strategic acumen will be instrumental as we continue to enhance our operational capabilities and drive forward our growth agenda. Further, Mr. Harshvardhan Gune joins us as a head of DAR, which is the Defense, Aerospace and Railways vertical. Mr. Gune has over 30 years of experience in the industry and will be spearheading our efforts to build our business from defense, aerospace and railway industries. Together, these two appointments mark a significant step in strengthening our leadership team and expanding our management bandwidth to seize new opportunities and accelerate growth. Turning to some of the key developments in the global industry. This quarter has been marked by a complex and dynamic operating environment. Globally, we are navigating volatility, while domestically market signals remains mixed. One of the most impactful recent developments has been announcement of new tariffs by US. On Wednesday, a 25% tariff on goods imported from India was confirmed, along with an additional 25% penalty tariff for trade involving Russia, effectively 50% tariff. These measures, rolling out from August 7th and August 27th, have prompted widespread caution across industries with global supply chains. Anticipating these changes, customers had already begun reassessing purchasing decisions and reevaluating supply chain strategies, awaiting clarity on specific rates. As a result, we have already experienced a slowdown in demand from our export customers in US and Europe. And with this announcement, there is likely to be further impact as customers will now respond to the implications of these announcements. The other significant global development has been the restriction on exports of rare earth materials by China. While China is stating national security concerns as the key reason, it is believed that this is largely a response to the increased US tariff on China. Our discussions with customers indicate that China has introduced complex procedural requirements and extended clearance processes, thus elongating the time period of shipments of rare earth materials for even genuine players. The impact is most adverse for supply of magnets for motors and towards requirements of EV players. OEMs are now urgently exploring alternative sources and technologies to reduce or replace reliance on these materials. These supply chain disruptions are already causing a production delays and shutdowns, with the effect expected to intensify in Q2 and beyond. We expect these recent global developments to primarily affect short-term demand, while the evolving landscape may present new opportunities. Initial disruption in both demand and supply are likely, and early signs of this are already visible in the current quarter. Now let's turn to our performance for Q1 of FY26. We have reported a revenue of 419 crore in Q1 of FY26. Revenues are lower by 5% year-on-year compared to 440 crore in Q1 of 25. Q1 of FY25. However, the operating backdrop in Q1 of FY26 was very different compared to Q1 last year. Our year-on-year performance reflects both the challenges we have faced and the strategic resilience we continue to demonstrate. On a sequential quarter basis, revenue are lower by 2% from 425 crore in Q4 of FY25 to 419 crore in Q1. Again, with the operating challenges having intensified in Q1, we are pleased with the resilient performance. We have overcome headwinds by ramping up volumes with some existing customers and with the addition of a couple of new logos. The appropriate way to look at our performance is that there has been a significant bounce back from the sudden dip in Q3 of FY25, and Alicon is stabilizing the trend of revenues of over 400 crore per quarter once more. Our gross margin for the quarter was 45.9%, a decline of 165 basis points from 47.5% in Q1 of FY25. This was due to a combination of price increase of aluminium and change in the sales mix, given the dip in export volumes. Additionally, our new technologically advanced plants are not yet operating at scale, and the fixed cost recovery is yet to reach optimal level. On key cost heads, we saw a slight increase in employee costs on a quarter-on-quarter basis as the annual increments and incentives took effect in Q1. Our cost optimization efforts are showing results, and we also benefited a certain one-time of costs incurred in Q4 did not reoccur. As a result, other expenditure was lower by 13% in quarter-on-quarter in Q1. This flow-through effect was visible in our EBITDA for the quarter, which stood at 50 crore with an EBITDA margin of 11.9%, compared to 48 crore and 11.2% margin in Q4 FY25. After a sudden dip in our performance in Q3 of FY25, which we had indicated was the bottoming out of our performance trajectory, we have now reported an improvement in EBITDA margin for the second consecutive quarter. Depreciation increased by 2.5 crore to 24.8 crore in Q1 from 22.3 crore in Q4, a direct result of our planned investments in machinery, tooling, and automation that are crucial for our future capabilities. However, lower finance cost has helped us to offset some of this increase. As a result, pre-tax profit was higher by 16% on quarter-on-quarter from 13 crore in Q4 of FY25 to 15 crore in Q1. Just a highlight is on a sequential quarter basis, top line was slightly lower at 419 crore compared to 425 crore in Q4. However, EBITDA and profit before tax, pre-exceptional, have shown healthy quarter-on-quarter increase of 4% and 16% respectively. We reported an exceptional item of 2.5 crore in Q1 and after adjusting for tax, reported a net profit of 9.3 crore in Q1. Largely stable on a quarter-on-quarter basis. Had it not been for the exceptional item, we would have reported a higher profit after tax as well on a quarter-on-quarter basis. This clearly showcases an improved performance in a very tough environment. A quick word on CapEx. During the quarter, we have deployed 30 crores towards CapEx. Our target for the financial year 26 remains intact at 165 to 170 crores. Looking ahead, the challenges are plenty. However, we are focused on ramping up volumes for some of our customers. Further new logos added this quarter will help add incremental volumes, and we are in discussion with our prospective customers too. We are seeing promising opportunities emerge in the defense, aerospace, and railways industries. These industries present a strong case of casting to do well given the variety of requirements. We think there is a space for meaningful market share of castings player in these industries, much like the success achieved in the automotive industry. Our initiative to form a separate business vertical and induct a head of vertical to spread our growth indicates our commitment towards establishing this as a key pillar for our business over the medium to long term. Our healthy order book of 9,100 crore, which span for financial year 2023 to 24 to 28-29, along with the new business wins and strategic initiatives like the DAR, vertical position us well to capitalize on opportunities and deliver growth. We are committed to navigate these headwinds with discipline and agility, and we remain focused on our core strategic pillars: product diversification, market expansion, and leadership in hybrid technologies. I am confident that these efforts will deliver sustained growth and create long-term value for all our stakeholders. With that, I will now hand over the call over to Mr. Shyam Agarwal, who will walk you through the operational highlights for the quarter.
Thank you, Mr. Vimal, and good afternoon, everyone. In Q1 FY26, the global automotive industry experienced a year-on-year increase of 1.7% in production volumes. However, the key geographies and product categories we serve within the broader industry landscape have experienced a year-on-year decline of 3.8%. So, allow me to provide further context here. Growth of 1.7% for the global industry covers all regions, and much of this growth has come from geographies such as South America, China, and South Asia. Since we do not have major exposure to these regions, our top-line performance should be viewed in the light of 3.8% contraction in the markets that we do serve. In the same period, the Indian automotive industry witnessed a 1.5% growth in volumes. A closer look at the growth across segments reveals 0.7% growth in two-wheeler segment, 3.4% increase in passenger vehicle segment, and 2.6% growth in the commercial vehicle segments, all on a year-on-year basis. Looking at the industry landscape, we saw several key trends in Q1 FY26. Two-wheelers. There was resilient demand from festive and marriage season. However, this seems to be easing out due to financing constraints, early monsoons, and persistent inflation. Within categories, sales of motorcycles is lower by 1.3% and mopeds is down by 8.3%, while the sales of scooter is up by 5%, and hence the two-wheeler segment is only marginally up by 0.7%. Passenger vehicles. The PV market felt the pressure from the heavy monsoon, tight liquidity, which weighed on the convergence despite various incentive schemes. As a result, inventory levels remain elevated at around 55 days. Utility vehicles continue to be popular with customers and reported to increase of 9% in volumes. Passenger cars, on the other hand, reported lower volume of 5%. On aggregate, production volumes of PV were higher by 3.4%. Commercial vehicles. While the CV segment reported year-on-year growth in production volumes, the pace of growth is slowing due to reduced infrastructure spend. Volumes of medium and heavy vehicles were up by 8.3%, while volume of LCV were lower by 0.7%, and the total segment is higher by 2.6%. Against the performance by industry, Alicon has reported the following. Contribution from PV business has increased from 38% in quarter 1 last year to 39% in quarter 1 FY26. For two-wheelers, the contribution has increased from 37% to 40%. Our sales to CV segment, which were 18% of total sales in quarter 1 last year, have declined to 15% in quarter 1 FY26. On the smaller categories, we have seen mixed trends. Revenues from three-wheeler have increased from 1% quarter last year to 2% quarter. Further, non-auto business has been dipped from 6% quarter 1 last year to 4% now. As Mr. Bimal indicated, there are a lot of headwinds in the operating environment. Despite this, we have reported revenue of over 400 crore this quarter. This has been achieved by adding new wins as well as ramping up with some of our existing customers. Coming to business wins, during the quarter, we have added 7 new parts from 5 customers, including 2 new logos. This includes 5 parts from structural businesses, 1 part from customer for the ICE business, and 1 part from the non-auto businesses. Out of 7 parts, 5 parts are for international businesses and 2 parts are for domestic business. The new business during the quarter include 2 parts that we are developing with a prominent European customer. This is a well-known Italian company with a focus on the segment of premium sports cars. The 2 parts that we will be manufacturing are technology agnostic in nature as they pertain to structural solutions. We have added a structural part with a domestic two-wheeler OEM. This solution has the potential to open the door for us to win similar businesses from several other domestic OEMs. Further, we have won cylinder head business from an Indian OEM for the non-auto business. These businesses will showcase capacity and capability of both existing and potential customers. In terms of ramping up volumes with existing customers, the outlook is favorable as with one of the prominent Japanese OEM, we have started supply of cylinder heads to one of their models, but the ramp up for second model was slightly delayed. I am pleased to share that production line issue have been fully resolved and we expect our production to steadily ramp up over the next 3 months. With another prominent Japanese OEM, we are witnessing steady volume offtake and they have indicated production ramp up from October onwards. For the Indian business of European OEM customer, there were some issues with the manpower which had impacted ramp up. This has now been resolved and they are set to increase volumes. We are installing a second production line in November, which will allow us to ramp up volumes further on. All of the above business pertain to supply of the cylinder head for PV clients. This is aligned to our strategy of increasing higher value products to CV and PV customers. I have already shared the contribution has increased from 38% in quarter 1 last year to 39% in quarter 26. And with the further ramp up scheduled over next 2 quarters, this is set to increase further. In our Indian operations, ramp up of prominent European OEM is underway. We are supplying around 40 to 50 sets of a key part each week and have been trying to ramp up steadily. However, we face some production challenges which delayed the ramp up. We have resolved the challenges and now progressively stepped up the production to 150 sets. Going ahead, we anticipate that this will further ramp up to 600 sets per week from January 2026 onwards. To support this ramp up, we engaged a casting expert from Germany who has since joined our team. His technical expertise has been instrumental in streamlining our processes, enabling us to scale up the volume efficiently. This in turn has helped lower our break-even point and improve overall operational effectiveness. As part of our drive to elevate manufacturing excellence, we are integrating digital process control and leveraging AI and IoT technologies across our operations. These advancements are enhancing real-time supervision, generating actionable insights, and enabling smarter decision making. The result has been marked improvement in productivity and a reduction in rejection rates, contributing to a more efficient and resilient manufacturing ecosystem. While the initial phase of implementation has led to higher depreciation and fixed costs, these strategic investments are expected to yield long-term benefits. As production scale, we anticipate a stronger margin profile, reinforcing our path towards sustained growth and operational excellence. Our customer base is undergoing a meaningful transformation marked by the successful onboarding of several prestigious global OEMs and Tier 1 suppliers. This milestone reflects Alicon's growing prominence in the global automotive ecosystem and reinforces our ability to meet the evolving expectation of world-class customers. Our business composition is increasingly defined by our strength in design, R&D, and value engineering, while earlier wins were driven by reliability and cost competitiveness. Today, Alicon is being recognized for its innovation, technological prowess, and design excellence. This shift positions us as a strategic solution provider rather than just a component supplier, reshaping how customers perceive and engage with us. We are also making steady progress on our sustainability goals. Our captive solar plant in India is now operational and complemented by solar panel installed at the European facility. These initiatives are helping us transition to a cleaner energy mix and reduce our environmental footprint, further aligning our operations with global sustainability standards. We can now open the floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. And just wanted to understand, like you have given contribution from auto and non-auto. So if you can bifurcate on the revenue mix side. And after that, this time domestic auto industry growth at only 1.5%. So how does you are seeing demand recovery shaping up for Q2 and H2 FY26?
Yeah. So, Jyoti, first of all, thanks for the questions. So, out of the revenue mix for the automobile, so two-wheeler is contributing 40%, three-wheeler 1%, passenger vehicle 39%, and commercial vehicle 15%. And remaining is the non-auto. And regarding your second question about the growth of the Indian automotive industry, you rightly mentioned that demand is subdued and it is much lower than what all OEMs have predicted or released the schedule to us. And there are various reasons also, which we all know. However, we are seeing some couple of customers where it is not linked to the growth of the automobile industry, like one of the Japanese OEM, where we are supplying, so that we will be, eating the share of their own foundry. That is the first thing. Second thing, for one of the European customer, they are assembling the engine and exporting out of India. And earlier they were having some manpower issue, so that has been resolved, and we are seeing the good schedule from the July onwards. So there we will see that we will, supplying the more parts than the industry is calling for. So in some of the areas we are seeing the good demand. However, we are seeing with some couple of customers the demand is not good. But as you know, we are dependent on our OEMs to, sell the vehicle, and then we can supply the parts to them. So we have to wait and watch for that.
Thank you, sir. And sir, on the export side, it was subdued. So what is the current outlook from global customers, particularly in Europe and US?
Okay. Jyoti, if you are talking about the US tariff, so this announcement has come couple of days before. So, we also need to take some feedbacks from our customers that what is their strategy and the other thing. But as you know, on the short term, these tariffs, what Trump has announced, like 25% from 7 and another 20%, 25% from 27. So these are only on the short-term basis. It is not the final tariff number. So every OEM, they will wait that what is the final contract signed between Indian government and the US government. That is the first part. But if we see, like in all our supplies to US customer, duty is paid by the customer. So Alicon is not directly impacted because of the increase in duty. However, in the long run, we have to see the competitiveness of the India vis-a-vis the tariff on the other countries like China, Vietnam, Canada, and Mexico. So once it will be finalized, then only, it will be more relevant to see the strategy from the OEM side. And until we have to wait and watch. However, we will stay in touch with our customers.
Thank you, sir. I will come in a queue. Thank you.
Thank you. Next question is from the line of Yash Dalal from Sushil Financial Services Private Limited. Please proceed.
Hello. Hi. Good evening. So I have a few questions. The first one is, what is the reason behind this exceptional loss that is reported? Hello.
That exception loss, actually, we are having a legal case in US court with one of our sales agent. He was claiming some additional commissions, and that case was going on for last 1 year, more than a year. So the cost, everything in the US when you deal for a legal case. So at the end, we made a out of court settlement with them. And finally, it was agreed of $300,000 as a one-time compensation to that agent. So that is a cost we have taken as an exceptional cost.
Okay, thank you. My next question is, with the rollout of the new product SOPs from the second half, how do you expect these to impact the company's growth trajectory and the margin profile?
Thank you, Yash. So, as we mentioned in our Concall also, we have lots of new products, and for that we have already done the PPAP with the customer, and now we are working on the ramp-up plan for the customer. So that is already, we have planned, and everything is going as per the planned ramp-up with the customer. It includes both domestic customers as well as the export customers. And this order wins or the products which we are launching in the second half of the year or the next year. So as we mentioned, our strategy is to work more with the passenger vehicle or the commercial vehicle side, so we can increase our margins. And we are working on that, and major volume will come from the passenger vehicle and the commercial vehicle side. So definitely in the coming quarters, you will see that our PV and the CV numbers will increase, and definitely the margins will also improve. So that you will see in the coming quarters. Yes.
Okay, got it. Thank you. And just in the earlier previous question, you spoke about the impact of Trump, the tariffs by Trump for Alicon. So just to add on to that question, is it possible, could we route exports through Alicon to mitigate these tariff impacts? If so, what could be the implications?
Yes, we thought about these options also. We have an entity in Europe, but it will be too early to decide anything until anything is signed off. Because how we changed the decision. Initially, he started with 10%, then 20%, then again came 10%, and now the 50%. So we should also have something robust for the long term, and then only we can decide.
But yes, definitely what option you are saying, that is, we are also open for that. Then we will take a call later on when we will have the reality in our hand.
Yes.
And with the customer agreement.
Understood. Thank you. And just one final question. So beyond achieving, 2,200 crore revenue target in FY27, what is the long-term growth strategy and vision for the company?
Yes, you asked very relevant question, but now you see the current environment is quite challenging, both on the domestic as well as on the global level. If you see the domestic market growth is not coming as much as we were anticipating, like finance minister has given the relief for the interest rates, income tax, and also the interest rate is coming down. So everybody was expecting with the more liquidity, the demand will increase. Same way for the Europe and USA, it was, last 2 years we were struggling and everybody was hoping that this year will be a good one. Yeah, but still we are seeing the demand from all the three regions, India, Europe and USA, is not that good. And considering the various warlike situation in the world and also now the Trump tariff, it is becoming more and more challenging for us to talk to the customers on the long-term perspective and define our strategy. Internally, we have made the plan for 3 years and 5 years, but it can only be, further reviewed once we get the final, numbers for the tariff. We talk to our customers, get their strategy on the long term for India, then it will be more realistic to give you more idea about our long-term planning. I hope, Yash, you can also understand these things.
Yes, definitely.
Due to
Thank you so
global
much.
volatility, and I think.
Yeah, sorry.
I was just saying, yes, okay, due to this global volatility, so maybe it will be better in the next quarter we'll talk about, we will have more clarity that how the things are moving.
And also, Yash, I would like to add here, we have already, mentioned earlier in our speech also, we are also seeing the rare earth issues, like Indian EV players, they are not getting the magnets from China. So their production is also getting impacted out of that. So, lots of issues are coming. So we should see that first these issues are settled down, then we can see what is the customer strategy to build our own strategy and the plan.
Okay, thank you so much. Understood. That's it from my end. Thank you.
Thank you.
Thank you.
Before we move to the next question, a reminder to the participants to ask a question. You may press star and 1. Next question is from the line of Preet from Incred AMC. Please go ahead.
Hello. Thank you for the opportunity, sir. My first question would be on the line of revenue and margin guidance, which you gave in quarter 4, that you are targeting to achieve 190 crores of revenue with 13.5% margin. Obviously, there have been a lot of headwinds in the industry. What is your current estimation for the internal targets for the current year, current targets?
Yeah, Pete, thank you. Thanks for the question. So, you rightly said, like we given the guidance in the last one, but now you can see the things have changed a lot from the last call, and we are seeing some strong headwinds from the US, Europe, and also the domestic market. So, of course, the number will change definitely. and how much lower it will be, that can only be determined once the things will be settled down. So please, we have to wait and watch the next set of numbers from the customer and how the tariff situation will be rounded off.
So, sir, will be there any change in the CapEx number which you have guided that you have told that you will be doing 320 crores of CapEx in the next 2 years, or maybe 170 crores of CapEx in this year? So is there any change in the CapEx plan which we will be doing?
No, please. We are not changing our CapEx. We are not changing our CapEx plan. We are very firm that we have to make the investment so that in the coming years we can fetch the good revenues and the margins for the company. And we are really making very strategic investment so that we can fetch new orders from the customer and also ramp up the current businesses which are in hand. So there is no change in the CapEx.
Okay. My last question would be in the line of margin differential. If you can give the difference or margin difference between export, domestic, or PV, CV, and two-wheeler. Obviously, PV and CV has higher margins, but what is the difference between, and also EV and non-auto, if you can provide?
So please, on the margin side, when we were talking, I think from last 3-4 quarters, the improvements. So you can also see the quarter-on-quarter now improvement is coming, and on the definitely we are having the good margins in the passenger vehicle as well as on the commercial vehicles. But maybe some headwinds were there in the quarter one, and maybe we saw that some decline in those what we were expecting. But on the other side, just see the kind of improvements we are having in our operations also. When the things will maybe little settle down, so our manufacturing cost is now started going down based on our lot of cost down initiatives that we have started, that we were talking about these initiatives from the last 3-4 quarters. So that has started giving the results, and maybe that will be our favor for this year. Maybe we will not see a big jump in the top line, but we will see the impact of our cost reduction initiatives that will give at the end the results of this.
No, sir. I was asking about the margin differential in export and domestic. What are the difference in the margin between export products and domestic products? What are the difference between PV, CV, and two-wheeler products?
So that I think you can say.
Yeah, please. So, of course, the margins in the export business, of course, much higher than the domestic business. And also non-auto is always more profitable. However, in the non-auto business, you see the volumes are little bit lesser, but in the regular business, you will see the higher volume. So export business is, of course, is having higher margin. So that is definitely there.
Okay. And one more question on order book. Like you have been mentioning from last 3-4 quarters that you have order book of around 1,100 crores from 24 to 29. If you can give the status of current order book or new order which you have added in last 1 or 2 years, maybe what are the new orders and in which segment we are getting these orders?
Yeah. So please, this order book of 9,100 crore, what we told. So out of this, if you see in 24 and 25, we have utilized 495 crore. And further, whatever order we have got, like last year, we added the order book of 1,600 crore. So that we added. But on the other hand, some of the businesses, especially the EV businesses, there we have seen the customers have reduced their projection. So that we have, eliminated from the order book, and the truncated order book after adding the new businesses, which we have got in the last year and this quarter. So the net order book is 9,100 crore. So what we are doing is, we are not keep on adding the new businesses or the order, but wherever we are seeing the reduction in the order or some of the programs are cancelled by the customer, so that also we delete from the order book. So the net order book is 9,100 crore.
It is executable by which year? Current status, order book?
It is up to 2028-29, Preet.
Okay, I'll join back the queue. Thank you so much, sir.
Thank you, Preet.
Thank you. Participants, to ask a question, you may press star and one. Next question is from the line of Devang Shah from Asit C. Mehta Investments Intermediaries Private Limited. Please go ahead.
Yeah. Hi, good evening, sir. My first question that in our initial remark, you have mentioned there is a global headwind and domestic also we are seeing some kind of, demand slowdown that is impacting company performance. So can we say as far as, worse is concerned, we may go further from here on, further down? That is my first question, as far as financial performance is concerned. Or it may remain as some kind of, flattish mode till we get some kind of clarity as far as, tariff and other related aspect is concerned. So I mean to say worse is still we may see further.
Devang,
You understood now what I'm trying to
Yeah, we
say?
can hear you very well.
Yeah.
Yes, we understood. And very, important question you have asked. If you see the current orders which we are having, so we see the growth, not the, slowdown or the decline in the numbers for the quarter 2, quarter 3. So that we are seeing. However, just to tell you, like the tariff impact of 50%, that has come couple of days before. So we have to see the new numbers from the OEMs which they release every month. But if we see before that the numbers, we are seeing a growth, not the decline. Devang.
Okay. And as far as domestic environment is concerned, this is respect to global user explained that we have to be a wait and watch. But what do you feel about domestic demand or something to have some kind of we may see a further momentum to pick up. So you may perceive any kind of thing by studying the industrial outlook or having a talk with the OEMs or something like that. Or else we may see a further sluggishness in this financial year as well.
Devang, we are closely associated with our customers, and as you know, we have a broader customer base, including two-wheeler, three-wheeler, passenger vehicle, and the commercial vehicle. And we monitor their schedule on each weekly basis. So there we see demand will increase. What we are getting the schedule, we are not seeing that it will be decline. However, the numbers will not be as good as it was given during the start of the year. Like everybody said, like two-wheeler will grow by 7 to 8%. And in reality, it is 0.7%. So we see quarter 2, quarter 3, there will be an increase in the number, but not up to the mark what was projected before the start of the year.
Okay. So, sir, my question is that why? Yeah.
Because I just add one thing. However, we have to see the impact on the EV, electric vehicle segment. Now, the China has not approved even the single license for the supply of magnet, and many of our customers' lines are dry. So there we are seeing that maybe, till September, of course, they will be dry. So until that license issue will be settled down, the EV volume we are seeing, it will be, declined a lot.
But yesterday, we may see some kind of, updates in, news that for a rare earth, magnets, there is OEMs are now looking for certain, low constitute kind of rare earth magnets, especially from a two-wheeler segment. That's what, yesterday some commentary, some update also came from some OEMs. So with regards to, certain things are, even policymaker or OEMs are also doing some kind of strategy, right?
Devang, you are right, but for each product to develop, come, and in automobile industry, there is a cycle of validation. So until those things are completed, you cannot put everything on the production line. So those things will take time. So we also hear such thing कि OEMs are working to reduce the rare earth impact on the vehicle. However, we have to see the validation cycle. And secondly, our major supply in the EV comes on the four-wheeler side. And when we see the four-wheeler customer, it is even, longer period to get the parts and do the validation.
Okay. So the last, concluding question kind of thing. So, sir, there is a guidance that is you have guided in a last quarter, and earlier participant also asked you that we may see some kind of, growth and revenue top line that we guided around 2,100 crore. So, as you are saying, we have to, you can get a final, idea in the next 2 quarters regard to that long-term growth, right, sir?
Absolutely. Absolutely. You are absolutely right. Thank you for that.
Okay. Thanks. Thanks.
Thank you. Participant who wish to join the question queue, you may press star and 1. Next follow-up question is from the line of Preet from Incred AMC. Please go ahead.
Yeah. Thank you for taking my question. I would like to ask about the cylinder head business. How much does it contributed in FY25 and how much it has contributed in quarter 1 of FY26? Hello?
Preet, specific to one product, we may not be having the exact number right now. But we tell you, in cylinder head, we are in very dominating situation. So we are supplying to many OEMs, of course, in two-wheeler, three-wheeler, and four-wheeler. But exact number we may not be having right now, Preet.
So, sir, what would be your top 5 products which you sell in, which contributed to revenue? If you can name top 5 products in the pecking order.
Okay. So, of course, first is the cylinder head. Yeah. Then we have the commercial vehicle cat tank business. Then we have manifolds for the passenger vehicles. Then we have the technology agnostic parts, which is common for both ICE and the EV industry. And then we have the EV parts like the e-axle, controller housings, battery housing. I hope I am able to answer your question, Preet.
Yes, I got it. Thank you. And if you can give the breakup of order book, maybe customer-wise or product-wise, or whatever information you can give about your order book, it would be very helpful.
Preet, we don't give the customer-wise the numbers. We can only give you on the overall basis. Yeah.
Okay. Any kind of information if you can provide about the order book, or maybe how much it contains from PV or maybe segment-wise breakup of the order book. Any kind of information which you can share.
Yeah, that we can give you. Yeah, out of this total order book, 51% contributes to passenger vehicles, 30% to commercial vehicle, 12% to two-wheeler, and 4% to non-auto. And geographical-wise, if I see, like 48% for the domestic and 52% for the export market.
Thank you, sir. Thank you so much.
Thank you, Preet.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to the management for the closing comments.
Yusuf.
Oh, okay. So thank you. As we have shared, we remain confident of an improved performance going forward. We are carefully monitoring the evolving developments in the macroeconomic environment and are confident that our deep engagement with customers and the growth plans they are indicating provide us comfort that we will see increased volumes going forward. We also believe that quarter three last year marked the bottom of the cyclicality in the industry, and we have seen a recovery in quarter four. And now further in quarter one of FY26, we will look to build on this further in the rest of financial year 26. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter. Thank you very much.
Thank you, sir. On behalf of Alicon Castalloy Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.